What is the federal funds rate? In answering this question, it's helpful to understand the role of the Federal Reserve, which is the central bank of the United States. The Fed's job is to manage the country's monetary policy and help keep the economy stable. The Federal Open Market Committee, which is part of the Federal Reserve, sets the target federal funds rate and uses it as a key lever for stabilizing the financial system.
Now we're ready to talk about the federal funds rate. It's the interest rate at which banks with excess cash lend money to other banks that need to boost their balances. For consumers, the federal funds rate is important because it affects longer-term interest rates for things like savings accounts and mortgages.
What is the current federal funds rate? On March 17th, the Federal Open Market Committee adjusted its target range for the federal funds rate for the first time in 2 years, increasing the target rate from near 0 to 0.25 to 0.5%. The FOMC expects to continue increasing the target federal funds rate as part of its goal to curb inflation.
How does the federal funds rate affect me? The Fed reduces the target federal funds rate when it wants to encourage economic growth. This helps lower the cost of borrowing. When the Fed needs to slow the economy down, for example when inflation is too high, it raises the target federal funds rate, which also helps increase borrowing costs. The federal funds rate is not an interest rate that individuals can apply for or that savings accounts can earn. However, it influences other interest rates that matter to consumers, such as mortgage rates and broader financial conditions. This, in turn, affects the spending decisions made by households and businesses.
What can I do to help combat rising mortgage rates? As of April 11, 2022, the average interest rate on a 30-year fixed-rate mortgage is 4.72% according to Freddie Mac. Compare this to the average rate on August 5, 2021, 2.77%. While market interest rates are outside of your control, there are different ways that qualified borrowers can get lower mortgage rates. Number 1. Increase your down payment. Generally, the more cash you put down, the better interest rates you'll receive. From the lender's perspective, your level of risk is lower when you have a bigger stake in your home. Number 2. Working on improving your credit. Borrowers with high credit scores typically receive better interest rates than those with lower scores. So make sure to check your credit report for any errors and keep up solid financial habits to give yourself the best chance of qualifying for favorable rates and terms.
Rising interest rates can cause prospective homebuyers to panic over borrowing costs. However, we hope this video helps you better understand and prepare for rate hikes in the future. Thanks for watching!